This segment sponsored by Foster Financial. Welcome to Money Monday, where we provide you with holistic financial advice from Caleb Doan, the Vice President of Foster Financial. Good morning.
Good morning.
How's it going?
It's going well. How are you doing?
Good. Okay, so today we're going to talk about something that's probably top of mind for many, which is election year.
Yeah, exactly.
Yes, and how investing could affect it, or just what people's portfolio looks like. So what do you have to share with us today?
Yeah, absolutely. I'd say it's probably one of the bigger questions that we typically get in election years. I'm sure a lot of people are getting mail out there, kind of telling them to get out and vote and all of that kind of stuff. But we always get a question, how should I invest during an election year? How should I change my investments during an election year? And I would say probably the biggest mistake maybe that people make is overestimating the impact that an election year has.
Okay.
Certainly has an impact on the market, can have an impact on your portfolio, but there are a lot of other things that have a much larger impact, like, whether we're in a recession or not, unemployment rates, Fed interest rates, inflation, all of that typically has a much bigger impact, whereas people tend to focus on, who's in the White House.
Right, and so what does this look like? I mean, tangibly, an election year, your finances, how does that impact each other, and how quick would someone see that impact?
Yeah, I'd say in an election year, we typically see a little bit more volatility in the markets.
Okay.
So a lot of times kind of getting up close to the election, people get kind of worried. There are people who maybe emotionally sell and they get kind of concerned about the markets.
Yeah.
Generally, somebody wins in November, somebody takes over, and then the markets kind of rebound and everything's fine. So that's typically what happens during an election year. So there's things that we do to maybe manage the volatility there. But one of the most important things is, hey, let's just stay invested. Let's, go according to our investment strategy that we had laid out before. And let's maybe not make an emotional decision with what to do with our portfolio based on, who ends up in the White House, essentially.
Right. Yeah, so people just tend to be more aggressive and like, oh my goodness, like they're jumping and making rash decisions without just waiting. So that seems more an immediate thing that's happening, but then long term, as you said, a new person that gets in, they can make changes to taxes, they can introduce new bills that could have something to do with inflation and all of that. Yeah,
that's exactly right. So I mean, long term, the policies that somebody introduces and is actually able to get passed can certainly have an impact. Fortunately, maybe fortunately or unfortunately, I feel like our Congress is not the best at passing new legislation. Right. And so, I mean, that can be a good thing or a bad thing. But it does add a layer of stability to the markets. And so presidents can come in and kind of have executive orders that can change things in the short term. But fortunately, the other president can come in, 4 years later and reverse a lot of those things. And so the market generally likes that there's some stability. It's difficult to make really impactful long-term changes. And when there are long-term changes like big tax cuts and stuff like that, that's when the market can get impacted. And so we take a look at those things as opposed to just, who ends up in the White House.
Yeah, so the top thing that someone should do is stay invested, number one. But number two, talk to an advisor. So talk to me how your guidance can really help people stay steady with all the ups and downs happening in the market.
Yeah, that's a good question. I'd say, advisors can certainly help with tax strategizing, maybe investing somebody according to their appropriate risk tolerance, and that's kind of on the positive side. But they can also help people avoid making mistakes, on the negative side. A lot of people who maybe self-manage their own assets, it's very easy to get emotionally tied to that. And if you see the market, like in 2022, drop 20%, that can be a scary thing to see. And so if you have an advisor, a third party, somebody who can kind of take the emotion out of it and say, hey, we've seen this happen before, let's look at the actual data here, let's make decisions based on facts. It can be a helpful thing to keep somebody invested and keep them kind of pursuing their long-term goal.
Yeah, because you all see those ups and downs year after year. Most people don't track that personally, so you all know what's happening. And so now that we are 5 months out from the election, I cannot believe that 5 months out, what does that look like in terms of the timeline? Is it too soon? Is it too late to start putting all these investing strategies in place?
No, I'd say now's a perfect time. If you don't have a financial plan, maybe you're somebody who retired and your money's just kind of still sitting in that 401k. Maybe it doesn't really have a financial plan, around it. There's not really a cohesive strategy. Now would be a wonderful time to talk with a financial advisor, maybe find some ways to manage the volatility as we get closer to the election, and really identify what your long-term goals are for that money. Is it, generating income? Is it leaving a legacy? And just investing towards that goal is the best practice.
Okay, well, it sounds like now is the best time to contact you.
Yeah,
and Foster
exactly.
Financial. Okay, well, thank you so much, Caleb.
Thank you.
And if you would like more information about Foster Financial, we'll be sure to have their phone number listed below so that you can contact them for your complimentary consultation. And I'll see you after the break. This segment sponsored by Foster Financial.